Welcome to the Cash Flow Academy podcast. I'm Andy Tanner, your host. This is where we make investing education fun, simple, and real. I'm joined by my good friends Corey Halliday, Noah Davidson. Guys, thanks for being here as always.
Thanks for having us.
We're going to have a great discussion. We've got the downgrade of the U.S. Credit rating, which is not the first time this has happened.
Second time, right?
Certainly it's big news. And so we'll be covering that. But make sure first that you like, subscribe, hit your notification bell so you're notified of new episodes. Share this with your friends. And drop by yourinvestingclass.com for free stuff. Now, let me tell you about this free stuff. The cliche people use a lot is, oh, this is life-changing. Everything's life-changing. And there's so much marketing out there on the web that it's tough to get caught in the noise. So judge for yourself. It's free. Go there. And just see, we've got, actually it's not a class right now, we've got an ebook we've got on there right now. And this ebook, when you read it, it's short, it's an easy read. When you're done, just see for yourself if you don't just look at that and say, this is life-changing. Many people will read books, like Rich Dad Poor Dad, or The Greatest Man in Babylon, or Think and Grow Rich. And those are great contextual books on changing your context to want to be a wealth builder. But I will tell you that this particular book is a step-by-step plan that provides a quantum leap into action. It is wonderful to listen and learn, but listening and learning only begins to impact when you start to do things. And there are certain habits that you can develop that are in this special book. Download it, go there, yourinvestingclass.com, put yourself to the test and just see if after you give it a read, even the first half of it, say, okay, if I start these habits and I do these things, my life, my financial life will change. So yourinvestingclass.com, go there. There's our plug. And with that, quick introductions. Let's begin with my favorite, everyone's favorite, Noah Davidson, ladies and gentlemen.
Hi, I'm Noah Davidson, and I survived Liberation Day, the market correction, and subsequent rally. I'm here to share that experience with you.
Yes, there you go.
Survived and thrived.
Yes, absolutely.
But you've been doing this for...
I've been trading. I started trading in like 1997 I remember specifically.
Al Gore only invented the internet in 93.
Barely invented the internet. It was on a 56K modem, which was pretty exciting considering we just upgraded from a 36K megabit per second.
28.8, 36K.
Yeah, it was a big deal.
You get to sit there and watch the page load.
Oh yeah, it's
step by step.
Oh my goodness, that was something, man. I'll tell you what.
But my instruction started out with learning how to click the buy button, and that was a big deal for me because I started studying the markets, engaging with the markets, and I've been a student of the markets ever since. So I'm excited to be here.
Awesome stuff. Corey, quick introduction.
Yeah, I got started around a similar time. I went the sort of traditional route of getting into the business and getting licensed, and started with a Series 7, which is a general securities representative. After doing that for a few years, worked my way up the ladder of the firm and became the Series 4 option principal, which is the head of option trading. Managed hundreds of traders, and the risk management for the firm, absolutely loved it, but that's a lot more high stress, let's say, environment. And I like what I do now even more, which is still invest my own money, trade actively, educate others on things that have made a huge difference. And you mentioned that ebook, income, expenses, assets, liabilities, how to capitalize on those, how to build your asset column, how to generate income, what we call stacking income, where you can bring in premiums and dividends and all these things that compound. And so I just absolutely love the markets, love helping people to achieve their goals in the financial world. And I believe as they do that, it ultimately improves other aspects of their life, their relationships with their husband or wife, and their relationships with money in general and with their kids and all those sorts of things. So
I love Corey and Noah, and I'll tell you why I love you guys. Many, many reasons. I was given a book way back when we were doing a book study as Rich Dad Advisors, and I think it was Kim that suggested this one. I'm pretty sure. It was by Ethan Hawke. It's a little green book about this big. You can read it on an airplane ride and get through the whole thing. It's short, but it's called Rules for a Night. and it's the story of a knight going into battle, and they've fought all day, and I guess everyone said, all right, time out, let's go sleep, and then we'll go fight again in the morning. So I don't know how they did it back then, but that's the context. And he realizes that, his division or platoon or whatever has been depleted. He's probably got his last night, and he's probably going to die in battle. So he stays up all night instead of sleeping, writing a letter to his children called Rules for Night. And they're the special things you learn. Well, one of them is humility. And it talked about arrogance being an inflated view of oneself. Well, if humility is the opposite of arrogance, humility is not an inaccurate view of oneself. It's an accurate view of who you are. And I love Corey because he's humble, and he says, I can't do this, and I can't do that, and I can't do this, and I can't do that. But I'll tell you, if you want to learn how to manage risk, if you want to learn how the markets works, that is the one gift I can offer.
That's right.
So it's awesome.
Yeah. Don't ask me about chemistry or geology or whatever, but if you want to know how to manage risk in the financial markets,
you can ask me about all those things.
Yeah.
You can ask.
Well, I can chat GPT.
You can ask, but it's great stuff.
Yeah, that's good stuff.
Topic for the podcast now. I remember the first time this happened. I think it was 2011, and it was Standard & Poor's. So I'm not an expert on credit ratings, but we'll do our best. At the personal level, you have like TransUnion and Equifax, and what's the other one? There's three of them.
Yeah.
TransUnion, Equifax.
These are personal credit rating agencies, but I forget.
I don't remember. Yeah, go to creditkarma.com. It'll tell you who.
Equifax.
I'm racking my brain because those are the only two.
Equifax is the one that I remember.
It's another
the most,
T one, I think. It starts with a T. Let's just do it. Let's just ask ChatGDP.
Who competes with Equifax?
What are the three credit ratings? TransUnion, Equifax, and ... Let's see what it says. It is Experian. It's a two E's, not two T's. Experian.
Yeah.
Okay. So anyway, those guys, you look it up, and you got your, 820 or whatever it is, or your 740 or your 620, or, when you go to buy a car. Well, you have Moody's and Standard & Poor's. They will rate bigger stuff.
Yeah.
Companies and countries and nations.
Isn't it weird? There's also three for that. Fitch is the
third.
Fitch
is the other
right.
one.
Yep.
Yeah, and Fitch has had in fact, Moody's is the last thing to fall. Now, Moody's is interesting. Warren Buffett owns some of the Moody's.
Yeah.
It's a Berkshire company.
Yeah.
And they kind of had some issues because they were the ones, Moody's. They were the ones that said, look at these CDOs. Look at these collateralized. These are mortgages. They must be safe. And look how diversified we are. We have all of these mortgages.
AAA rated.
How could they all go bad?
Yeah.
So individually, they're like, junk level credit, high yield.
Yeah.
Junk level credit. And collectively, all of a sudden, they're AAA. So
because,
Moody's.
Yeah, their philosophy was, well, we've never seen a mass amount of defaults of all of this big percentage. So we'll assume the same percentage will default in the future. If you package them all together, well, this could work out as a good investment.
So there's the Big Short.
Yeah. You pile together a bunch of junk, and somehow it became AAA rated.
Historically, we've never had this problem. Of course, we've never had zero down, no doc stated income loans either before. So anyway, they rate. They put ratings on debt, and this creates a really interesting debate and conversation. I love talking about this stuff. Justification for MMT. What is interesting is that sovereign nations have different rules than corporations and households.
Yeah,
corporations and households cannot run at deficits for very, very long before they die.
Yeah.
Nations, they can run a long time with massive amounts of increasing debt before they die.
And you look at how these credit rating agencies will grade different things. So if we were to compare corporations as an example, you have Apple and Berkshire Hathaway and these companies that have a massive amount of cash. They're well-run businesses. They pay off their debts. when they borrow money, they're going to pay low interest rates because it's like they have a credit score of 850, whatever.
Perfect scores.
Right. Then on the other side of that, you have these companies that are struggling to make ends meet. They're borrowing because they need the capital and they're struggling and their business is deteriorating. Maybe they've defaulted in the past, what have you. Well, those are considered junk bonds or high yield bonds, right? And so the risk is when you buy those, they promise a higher interest rate, but they might default on that, right? And so they might promise you 10%, where Apple is only going to pay you 4% if you buy their bond. You're making 6% more if you buy this junk bond, if they continue to pay and if they don't default. So that's the risk to reward spectrum. It's interesting that within governments, it's the same thing. So Moody's, S&P, they're rating these governments and they're saying, okay, this government is running better than this other government. Well, that's where these ratings would come from. Countries like Argentina have defaulted multiple times on their government debt. And so they've actually had, I think most recently, they sold like 100-year bonds or something. And again, they've defaulted. So a country like Argentina has to pay a higher interest than a country like the U.S. or somewhere that hasn't ever defaulted.
Right.
But basically, if they go from AAA highest score down a notch, they're not saying that the U.S. is almost to default, but they're saying that the risks of potential problems in the future are higher. They're basically assessing how much debt does this country have? What are they bringing in? They're looking at the numbers and they're trying to make some justification for why should they be triple A or should they be down a notch? And so Moody's came out and said, no, U.S., you're worse off than you've been.
The world is run by regular people, I'm telling you. You've got some outliers like Warren Buffett who are just brilliant, but he still makes mistakes. We all do. Everyone makes mistakes. Vladimir Putin makes mistakes. Donald Trump makes mistakes. There's no mistake-free people other than my mother-in-law, and she's now passed. Yeah. So, other than that, that's it, right? Yeah. And so the fact of the matter is they make mistakes. Well, the reason I bring that up is when you look at a title, whether it's a corporate title or political title or even a religious title, we tend to elevate these people as, like Hercules, like a demigod or something, right? Alan Greenspan, he must be brilliant. I mean, you look at Bernie Madoff, he used to run the NASDAQ. He ran the NASDAQ. Yeah. You got the biggest crook in the history of history running the NASDAQ, They're regular people. And they make mistakes. And Alan Greenspan came out we were talking about this before the show. Alan Greenspan comes out in 2011 after the Moody's downgrade.
That's when S&P.
S&P
downgraded the U.S. for the first time.
They downgraded it for the first time. And he blew a gasket. He's on CNBC getting interviewed. The guy blew a gasket. He's like, this is ridiculous. The U.S. can pay any debt that it has because we can always print money to do that, unquote.
Yeah.
And so it brings up an interesting thing because he's right. The risk of default is zero. Now, the risk that those dollars they give you are worth anything is in question. And that's the big thing.
Well, and I would even say that the U.S. is considered, quote unquote, risk-free, right? Because everything in finance uses that as the baseline. Yeah, they say, if I can get 4% from the U.S. government risk-free, then you have to pay me more than that for me to be compensated, right? So I need to get 5%, 6% from a corporate bond. Yes. And that's part of the problem is that U.S. government debt interest rates are ultimately based on supply and demand of buyers and sellers. If people basically are selling bonds, that's going to push interest rates up higher and higher. And now the baseline behind U.S. government debt, quote unquote, risk-free, goes higher. All the other corporations that have to acquire more capital, they have to pay rates that are higher than the U.S. And so the market has forced the U.S. interest rate higher, basically. And so that means every other corporation has to pay higher interest rates than that. It's interesting because the U.S. is, let's say, a 10 years around 4%. Germany, like 2%. Japan, well below 4%. So the market is saying, actually, German economy, some of these other countries are going to pay off their debts, or at least, the mechanics behind it are saying they're less risky than the U.S. And
well,
the U.S.
Germans,
being,
all they got to do is throw in a beer tax, and they'd have unlimited revenue.
but
right?
Pretty
My
much.
cousin lives over there. I'm like, do you indulge? Come on, man. You got to push a little bit.
For
Come
sure.
on. You can't go over there and not do Oktoberfest just once. Come
I
on.
would imagine that
Come
would
on,
be
Dave.
the best tasting anywhere.
It's really interesting. I mean, these are really complex, monetary. If you have ever studied the history of money and kind of how it's evolved over time,
Fascinating.
it's absolutely fascinating. And kind of the situation we're in now is, U.S. has been the world reserve currency since World War II, since really the Bretton Woods Act. They suspended the convertibility from the dollar to gold in 71?
Yeah.
And since then, it's really come down to the demand for the dollar globally in global economy to settle any transaction or debt, right? So you can increase that monetary supply, and that really heats up economies worldwide. And what we're seeing right now is it's really based off of the bonds, obviously, and you've got big holders of U.S. bonds in kind of retaliation to the tariffs, selling U.S. bonds into the marketplace and just flooding it with inventory. And that's one of the reasons the bond yields are shooting up.
Bring you to the table.
Yeah, and then the other number that's probably the most important number behind all this is not just the debt. I mean, the debt's 36 trillion some odd dollars. Mm-hmm. It's the debt to GDP ratio. That's the key. That's the key number. Most
important number in sovereign fundamental analysis, in my opinion.
And that continues to get worse and worse because we keep running at deficits, right? So we don't have enough to pay our bills. Yeah. So now we keep borrowing more and more and more. So that amount that we have to pay back gets larger and larger. Now, like you said, interest rates have gone up, which is not what Trump expected.
Kind of slows down GDP.
It slows down GDP because, think about it just from a simplified version. AT&T, Verizon, some of these companies, they have $100 billion worth of debt. They have to go and refinance that debt as it comes due.
Correct.
If you have to refinance, so if your debt comes due, they don't have $100 billion in cash. So what do? Well, they have to sell new bonds to repay the other ones. The old ones during pre-COVID, they were probably selling bonds and they had to pay 3%, 4%, 5% interest. And now it's going to be higher interest rates. That hurts them.
And that's your misery. Because here's the deal. If you're trying to fight inflation because you're printing so much money, what do you have to do to rates?
Yeah.
You got to raise the rates. And so when it's time to refinance, you're killing yourself because you're having to refinance at higher rates than you did before. So and what's interesting, that's where stagflation is so bad.
Yeah.
Because in theory, you say, well, if the economy slows and the GDP slows, we should have prices drop, right? But if you're pumping money all the time, this can feed on itself and have problems. In my new 401 Chaos book, in my new 401 Chaos book, I did a graph. You have you have the baby boomer. Well, the World War II guys, they're kind of we're almost out of those guys. You got baby boomers now. Then you got us, Generation Xers. And then you got the Ys and the Millennials and the Zs. And then I think the new ones that are being born now they're called Alphas. They're starting over again.
Oh, really?
Yeah, they're starting over again.
Makes sense.
The Alphas.
We had a good run.
When the Alphas, I did retirement for all these guys, all these generation retirement. Alphas are looking at a debt to GDP between 500 and 600.
Jeez.
At the rate we're going.
So
5 and 600. And the millennials aren't much better off. They're like 300.
Yeah.
And Japan was at 256 for a long time, and look what they've done. Look at their market for the last 20 years. It's a piece of crap. So when we come back from break, I'm going to ask both of you so you can get thinking about it. This is fun to talk about, but it becomes valuable when we can take information. This is basically the first pillar we're talking about. It's fundamental analysis. When we can take information, but then we can use it to position ourselves for cash flow. So when we come back, I'm going to ask both of you, what does this mean, and how does it affect your investing when we come back?
Responsive to questions, they're very detailed in their training. You can start from no investing experience whatsoever and get educated and be able to make a nice retirement for yourself or even a living. It's an amazing educational system, and I would highly recommend it. The one thing that will get you more confident in investing is your education, your competency, and if you can get to that point, you can do anything.
Welcome back to the Cash Flow Academy podcast. I'm your host, Andy Tanner. This is where we make investing education fun, simple, and always keep it real for sure. Grateful for my guests, Noah Davidson and also Corey Halliday. We've been talking about the downgrade. Another number, we mentioned debt to GDP. There's another number that's kind of runs second place to that. And it's the spreads on the credit default swaps. When you look at the best people in the world, if you want to talk about risk, are insurance companies.
Yeah.
And they have premiums will tell you risk. So look at your own household. I have teenage sons. We're driving a red sports car with a lot of horsepower in it, right? Their insurance is going to be more than, say, my wife's.
Yep.
Don't know if that's accurate because my wife will put the hammer down once in a while. She'll do it, but it's just risk. And so a credit default swap is a fancy name for insurance on these bonds.
Yeah.
So if we used to have Portugal, Italy, Greece, and Spain, where they unfortunately, called that acronym the pigs, and they were just in dire straits.
Yeah.
And so you looked at particularly Greece. You have an interesting dynamic because you have a monetary policy that's combined through, 24 countries roughly, but you have individual fiscal policies. So you have Germany, had the Weimar Republic. They remember still austerity is important for those guys, and Greece is just everyone's a government employee. They got, everyone in Greece works for the government.
The national pastime is not paying taxes.
Yeah, exactly.
There's a lot of things going on there.
Yeah, Greece was a mess. And so you had Germany saying, "Hey, EU, quit printing money and bailing these guys out," and so they had austerity measures, and the interesting thing how that affected them sociologically. Traditionally, the Greek Orthodox Church, if you commit suicide, they don't give you the funeral, the formal funeral. No, you committed suicide. So they were lowest in the world in suicide rate. Pre-austerity measures. Well, when they made all these austerity measures, all these government employees were let go, much like the Doge action going on here. They were let go. And these guys were mortified about the idea of either starting a business or getting a different job because you kind of have a merit-based, outside of government, you're kind of merit-based.
Yeah.
And so you kind of get paid what you're worth. And these people were a horrible human tragedy. Some of them would take their own lives because they didn't know how they were going to face reality without that job. So it has a big impact.
Well, that's the tough part about Europe, where they're sharing a currency. Mm-hmm. And so when it comes to money printing, well, we use euros and you use euros and you use euros, but now
our fiscal stuff is all different.
It's different. And so Germany says, well, we've been running our country well, and so we pay low interest rates, but then these other countries are saying, well, maybe it's our own doing, maybe it's not, but we have to pay really high interest rates. How do we solve this? And if we can't pay our debts, what do we do?
The currency for
exactly.
Germany.
And so do we continue to print money and bail these guys out? And then you've got the other side where Germany and these countries are saying, we don't want to bail out Italy or Portugal or
not our problem.
Greece. Exactly. And so that's the difficulty. Whereas in the U.S., well, we have 50 different states, and we might want to get rid of one state or another. But the reality is
You don't want Canada?
yeah.
We voted you off the island.
Yeah.
You're
You
out.
want Canada?
Yeah.
I said the
51st state, Canada.
I said the Gulf of Mexico the other day, and someone reprimanded me. They go, "Don't you mean the Gulf of America?" I was like, "Oh my goodness, what world am I living in?" Good, but can't call stuff what it is.
Even within the U.S., you can kind of look at it that way, as the U.S. government will bail out certain states. They'll do things where, hey, this state has this issue or that issue, and we'll send government money. And you might have other states that say, hey, we don't want you sending that money. We're running our state well. And so you'd have it, but it's, I would say, a lower scale of problem compared to Europe, where those countries are different religions, different way of life, different languages.
Well, and the U.S. has had an express advantage with being the world reserve currency, having the petrodollar.
Right.
And they've been able to print. They've been able to export their inflation for the most part. And nobody really knows where that limit is when, if you've printed too much. We recently have seen the inflation rates pretty uncomfortable.
I think COVID kind of gave us a clue of where the limit is.
Somewhere in that ballpark, but it's there at a certain. And again, maybe you can correct me on this if I'm wrong, but it's a confidence level. That's one of the things behind inflation is how much confidence do I have in this currency, and am I going to keep this currency and spend the other one? Like when you have competing currencies.
I'll tell you where it flips. I'll tell you where it flips. We don't know when it flips, but we know where it flips. It's where, like right now, people see cash as an exciting, flood me with it, let's make it rain. I want a bunch of cash dumped on my head. When people actually realize that the cash isn't worth anything and they want to get rid of it quickly, that's when you go from inflation to hyperinflation. It's that simple, where they don't want cash, they want something else. When you'd rather add a good or a service, and you're going to buy the bread today because you're scared it'll be worth so much more tomorrow, that's when you're getting rid of your money today.
That's like the old adage of the guy that has the wheelbarrow full of cash in there, and the people come and mug him and dump out the cash and steal the wheelbarrow because the cash wasn't worth anything.
But this brings up an interesting thing with Warren Mosler. Warren, I don't know if you're a listener. I don't think you are. I would love to have him. Look, I'm not going to fight with you, Warren. I just really want to ask you honest questions. Warren Mosler, I've invited him on the podcast like a bunch of times, and he's declined. And I don't know why he declined. I mean, I'll be fair. I'll be fair to him. But I really want to understand, I'm just because I'm not a proponent of MNT doesn't mean we couldn't talk to each other, because he, can convert me. I don't want to argue. I just want to understand.
Yeah.
And he has interesting writings, but Warren Mosler was a bond trader, successful. I think it was Spanish bonds. I think he was really into, and he was kind of like Greenspan. He's like, look, these guys, the bonds are not going to default. They'll print money and pay their debts. It's not a big deal. And this was probably pre-Euro that he was doing this. So it was a peso or whatever. You were over in Spain. What was it?
Spanish peseta.
Well, there you go. You're in Puerto Rico.
Say that.
You don't know anything about.
We use U.S. dollars in Puerto Rico.
You're in Puerto Rico, so you don't.
That's dollarization. That's another rabbit hole you can go down.
Yeah, you can. But he says, look, and then Stephanie Kelton, Bernie Sanders' right hand, she wrote the deficit myth, saying it's just all this stuff is a total myth, and the U.S. can pay any debt it has because it can always print money to do that, and deficits don't matter and all this. I think they do matter. I think an Argentina shows that they matter. I think a Weimar Republic shows that they matter. And I know Zimbabwe was more of a corruption type. That's a little anomaly. That's not the same. But
I would say the biggest risk is not so much the debt. It's the currency on the side, on the impacts of the currency due to the debt and due to the lack of confidence. Because
and the impact on the economy, like you say, having this debt.
That on the economy as well. But you look at the currency, the single greatest risk to the U.S. is really losing confidence in the U.S. dollar. I mean, imagine the worst case scenario and what it could look like, where we go back to, complete chaos and catastrophe. I don't think we're going that way, by the way. I think 50 years from now, people will still be investing. But the worst case scenario is the U.S. dollar collapses and inflation is rampant and people don't trust. I mean, the only reason you have a $100 bill and I can hand it to you and you'll give me something in return is because we both agree that that's something real. If we both don't believe that it's real anymore, we got a huge problem. And so that's not an issue for today, but these things have a way of, it's not the U.S. wouldn't be the first one, by the way. It would be other currencies that would collapse.
Well,
I'm
more afraid of arrogance than anything else.
Yeah.
There's an old saying that says pride comes before the fall. So I'm more afraid of the arrogance. There is a fiscal, I mean, I remember, I've been talking about this for decades, and I remember when we hit $1 trillion in debt. We hit the first trillion. That's in my lifetime. So think about how long the U.S. has been around before I was born, and it took us, 200 years almost, a little more than 200 years to get to the first trillion. Now
you're in the we're approaching 40.
We're getting at 40, and if you look at the debt clock and go to 2039, it'll be like 43 or 20. What is? Yeah, 43 trillion. But here's what's interesting: the off-balance sheet obligations that we have, meaning the unfunded liabilities, and people should really learn this. A funded liability is when you borrow money and you receive the funds and spend it. So we borrow money and we have funds. It is funded. They give us the funds and we spend it.
Yep.
Unfunded liabilities is where we haven't borrowed the money yet. We don't have the funds, but we still have obligations.
We made promises.
So we have massive healthcare promises, pension promises, what we call income stability. And these monies only serve, if you print money to pay for these programs, they cause prices to rise. If you got rid of borrowing money, the housing market would collapse. If you got rid of student loans, tuitions would go down. If you got rid of healthcare funding, healthcare costs would go down because, well, people couldn't afford them. So they got to drop the price if you want to make money as a doctor or an insurance company. So it's a huge problem that where the trajectory, I read these reports all the time, and the word is unsustainable.
Yeah.
So, you have this idea of debt, risk-free debt at one extreme, risk-free.
Yeah.
The word unsustainable at the other extreme.
Yep.
And you have to reckon as an investor, look at Noah laughing.
I'm like, well, one tiny conversation about a downgrade from AAA to AA1 or whatever the rating is, and we're talking about currency, defaults and hyperinflation.
Dogs and cats living together, mass hysteria.
Yeah.
No, but it is looming out there in the future. It is looming. It's not here today. It's like global warming. No, who cares? It's not happening today, right? Yeah. Not happening today. No ocean boiling today. I see a fish in there. He's fine.
Well,
right?
I'll tell you one thing that the economists fail to talk about is the underlying attitude, beliefs, psychology, and temperament that are running on the undercurrent of the economy. Are people feeling confidence, or are they feeling scared? Are they feeling abundance or scarcity? I mean, it's kind of that mindset. And I do think one of the things that's happening right now is, you talk about the Trump administration, all of a sudden people's emotions pop up one side or the other. But they are doing, I think, a couple of interesting things. They've kind of just got back from this Middle East tour. Mm-hmm. And they've kind of rallied this, like, you like money? We like money. Let's make money.
Yeah.
And there's been some positive spin on that. And our biggest competition out there right now is China.
Yes.
And China has their entire BRICS system where they really have a competing currency.
They do.
But at the end of the day, about 30% of their GDP is contingent on our consumption. And so
that's why they can't liquidate the bonds aggressively.
100%.
That's why they can't.
So and it comes down to a posturing thing, one of the things that I actually appreciate about the current administration is the psychology behind it is like, we're going to win. We're going to win. We're going to build. We're going to grow. And all of a sudden people are like, hey, you know what? I kind of like what he's saying.
Yeah.
Because on the other side, it's just fear,
Yep.
problem. But it's like, they come back and have a little rah-rah tour. And
Well, Reagan really did well with optimism. So
He did.
They've taken a chapter out of his book because he was a total, city on a shining hill and,
100%.
all that optimism stuff before he sold arms to Iran. Now,
We don't talk about that.
Yeah.
before he sold all the guns to the, I mean, it's politics, man. Come on. I'm such a cynic. I hate politics. To me, they're all just, I roll my eyes at all of them.
Well, it's all like, it's
but
all
I do
World
appreciate
Wrestling
it.
Federation.
I'll
at the
buy
end
into
of
a
the
little
day.
rah-rah.
I was
stuff.
watching a Netflix just about the Taliban, about capturing Osama bin Laden. I think it's a new one that came out. And it was talking about how Russia had invaded Afghanistan,
Yeah.
and we were supplying the arms
Yep.
to the Taliban and to them fighting against Russia, and then how that came full circle and the whole Osama bin
Crazy.
Laden. And so it's a tricky world. But I will say this. A lot of this sounds super, super scary when you start thinking about that. I think at the end of the day, people are not going to lose confidence in the U.S. dollar to the extreme where we're not going to believe it
We're
holds
not
value.
Zimbabwe.
Right. It's going to be around for our lifetime and our children's
We're
lifetime.
just not
and-
the same country as Zimbabwe.
but I do think on the flip side of that, there are some serious problems with unsustainability. And so you have to make some hard decisions or those get worse and worse and it creates a problem. It's like a household. If you continue to borrow and borrow and borrow and not pay off what you're borrowing, eventually you get into a big problem. Now the US, how do we get around that? Well, we're going to have to make some tough decisions at some point in time, hopefully sooner rather than later, so it's not as big a crisis. But Warren Buffett seems to think that there is something coming. He has more in cash than he has in stocks.
So there's the perfect shift to answer the question. I know what my answer is, but we promised the viewers I was going to ask you, okay, how does this affect your positioning? Let's start with Corey.
So I still own a lot of stocks, but I have been more defensive without a doubt in the last while. I would
July.
say, yeah. I mean,
June.
yeah,
Almost a year.
Well, going on a year, I'm playing it more safe. I would say I'm looking at positioning in a different way where a lot of the stuff that I want to own are things like Berkshire Hathaway as an example. I feel like heads I win, tails I win type of thing, where it's like I can continue to generate some income. I've got a company that has a large cash amount.
Do you write calls on your Berkshire?
I do.
Okay.
Yeah, I do the
far out of
B
the money,
shares, of course.
Yeah, pretty far out of the money though.
Usually, yeah. Usually quite, and I'll do a variety of different. I do some 1x2 spreads on them, and some of the things we teach in our ultimate options. But that's my single largest position. So I was loving that earlier when the markets were tanking and Berkshire was hitting a new high. I was like, this is the best.
Yeah.
This is the best market for me ever. But it's since markets have recovered and whatnot. But I still, I've bought some things along the way. We've talked about gold and gold miners and why that can be an area of interest in the last year. And gold miners and gold has done really well. So I've been more defensive that way and getting out of, some of like the big tech names where I think they're still going to be strong and they're going to be AI winners. And so I like them, but I don't love them like I used to. Maybe.
Noah, what are you doing?
Well, I'm sitting on a little bit more cash than normal. Still own stocks, write covered calls. I like that because you can continue bringing your cash flow. On the cash holdings, I am selling puts to acquire stocks that I do want to own, but keeping it kind of in a cash reserve with high probability out of the money puts. And then I'm doing debit spreads and kind of, I don't even know what we describe them, asymmetrical imbalanced butterflies, where I'm taking a small amount of capital and creating asymmetrical risk reward scenarios for myself so that my downside risk is fixed. I know what it is. I know how to manage it. And then I have that potential for growth.
I think for you this matters the least because of the way you trade.
Yeah.
You're more active. You don't mind a swing trade. You don't mind a short position. I think the vicissitudes of the economy and currencies affect you the least because every position you have is just based on risk management as an active swing trader.
Well, and because I am so bad at predicting the future sometimes, I've just learned how to adjust and mitigate risk to the, and change my position, add on, an option.
I mean, you're really managing a price movement in a price chart, regardless of what the underlying reasons of the movement are. I kind of agree with Warren Buffett in heads you win, tails you win, because he has the perfect financial statement.
Yeah.
He really does, because with the amount of cash you've got, it would suck to have that much cash because inflation hurts you. But if you do have a tragedy, you've got so much money to buy those dips. But if you have a currency devaluation, you've got all the currency in the world. So it's really, he's just a balanced balance sheet where he's got equities, he's got this, and in one scenario he's got so much of this it'll do well, and in the other scenario he's got so much of the other he'll do well. So that the balance sheet is wise. For my stocks, most of the stocks I own, I bought so cheap, I'll never sell them.
Yeah.
To me, it doesn't really matter that much as long as there's an options market. Certainly the dividend could dwindle if there were troubles. But some of the stocks I have, they're pretty solid dividend. I mean, their dividend history is pretty interesting. I listen to some of the corporate calls when they have their earnings call because I'm a shareholder, and it's interesting to see how they're trying to deal with the uncertainty of tariffs and things like that. But if you ask me, a little bit of gold. I think that the worst case scenario is, it's like my life insurance policy. I don't know that I even need one now, but when I was younger, I got one, so I've had it and kept it. But I don't think I'm going to die. But if I do, I've got a little bit of insurance that goes big. Well, that's how I look at gold and gold miners.
Yeah.
And we mentioned that. I sold my Barrick and just took all that and moved to Newmont simply because I thought the options were better and the dividend was better. And so I sold my Barrick and just made a lateral move.
Good swap.
It was right around. I got. I don't want to act like I know what I'm doing here. I got lucky. I did it right at the right time when I moved that, so that was good. I mean, I think a little defense, but not to lose your mind.
No, the gold trade is actually getting long in the tooth, where we talked about this months ago and loved it.
I was actually thinking I was going to unload my a lot of gold, and you said, Andy, you probably ought to.
So it's not something that I'm buying more of here. Let me be clear on this point.
In fact, calls on
it's been good, but
if you own some GLD, some aggressive call writing might be in order.
Yeah.
Right. Now, might be in order at the top. The last thing I'll say about this is, the reason this downgrade news is such an educational opportunity is it opens up the window for us to want to learn more and share more and discuss it. It brings up a great time to talk about it. I want to just go back to this idea of risk-free and this idea of, I write about this in 401 Chaos a lot.
Yeah.
Because you have this saber rattling of Democrats and Republicans when it's time to raise the debt ceiling. And the threat is, we'll shut down the government. And when the Republicans are in power, the Democrats are like, see, you're not going to get your Social Security check. They're going to shut down the government. They use the fear. When it's reversed, well, look at the dang Democrats. They're going to shut down the government. So it's just saber rattling. Yeah. And Janet Yellen is hilarious as a Treasury. Week before they raise the debt ceiling, she's something, man. The week before, Janet, you're welcome to come on too anytime you want. Chairwoman Yellen, not Janet. You're welcome to come on anytime and explain yourself on this. The week before they raise the debt ceiling, she says, we're going to have catastrophic ramifications if we don't raise the thing. We raise the debt ceiling. Then they ask her about the U.S. credit range. She goes, oh, we're solid. She goes, there's no reason to be full. I think Fitch was talking about, hey, maybe we should downgrade again. Fitch was talking. She goes, what do you mean, Fitch? Look at how powerful we are. Well, a week ago it was catastrophic, Mrs. Yellen. So anyway, that's neither here nor there. What I do think is important is understanding that the risk-free rate is a confidence issue, because here's why. If you look at a Sharpe ratio, where you're trying to figure out how much reward you're getting relative to the risk you're taking. Like you might be getting a low reward and taking massive risk without knowing it. So a Sharpe ratio helps me understand how many units of risk I'm taking for how many units of reward I get to enjoy.
A good way to think about that is if two people make a 20% return, are they both equal? No. The one that took less risk and still made 20% is better than the one that took an enormous risk and made 20%.
So you have a floor on borrowing money, and that is set by the Fed really in 2 or 3 ways. Number one way they do it is with the interest rate they pay on member deposits at the bank. And then the number 2 way they do it is on credit or on reverse repos, which the money markets and the internationals, those guys can participate. So if the Fed is doing money at risk-free rates, you can't loan any money anywhere else below that without being stupid, because it's not risk-free rate at that point, right? You're always going to have a floor that's set by the Fed. Also, the reason the risk-free rate is important to understand whether or not it's in jeopardy is because if you read The Intelligent Investor by Benjamin Graham, he has a sample value formula, and it's value equals X, and there's growth in there and there's earnings in there. Well, there's also a variable on corporate bonds, because if corporate bonds are considered less risky, like if everything falls, they pay the corporate bonds first, and then the shareholders get what's left over. So shareholders and owners have more risk than people who lend.
Yep.
Well, it's all relative. So if you're going to have this foundation of risk-free rate and all other investing decisions are made based on beating that rate, because Buffett Benjamin Graham is saying, look, we can't see value in stocks unless we're beating bonds significantly, right? We can't value that way.
If I can get 5% with quote unquote risk-free, then I better make 10% in stocks.
Exactly. So we've got to look at growth rates against a corporate bond rate is how that valuation works. Well, you have this, so the main point that I'm taking a long time to get to is when you have this foundation of risk-free, and all of a sudden that goes from AAA to not AAA, that means it's not risk-free.
That's what they're implying.
That it's not risk-free. So that, I think, is a big part of why we kind of go...
a little bit of risk. Itty bitty risk.
Well,
a little bit.
Come on. I mean, who's perfect every time?
It's 99% probable.
It's a little risk. The risk-free has... Okay, so the risk-free isn't quite risk-free, but it's still the best risk-free you can get without being totally risk-free.
That's just adding an ish. It's risk-free-ish.
Yeah.
It's risk-free-ish. It's not risk-free, but it's free-ish.
And isn't Moody's the last one to actually make this downgrade? Like the others already made it.
Well, I think Fitch is still holding out.
Are they still holding out?
S&P and Moody's have now both gone down a notch. So.
Yeah. So, but that to me is the biggest news of it, because if you're not AAA, you can't be risk-free and not have a AAA rating.
Right.
Because risk-free is
those
the best
two go
rating.
together.
You should almost have your own rating. AAA, A+.
Well, yeah,
with a Noah Davidson stamp of approval.
Well, to your point, Apple Incorporated can sell bonds at a AAA rate. So they're saying, these credit rating agencies are saying that you'll have less risk with owning Apple bonds than the U.S. government.
To me, that is the most significant part of the downgrade. Is they're supposed to be risk-free, but they're saying that they're not. Right. That is why Alan Greenspan blew a gasket. Because he's like, we're risk-free. We can pay all our bills back.
But this is why governments can't just print money to pay off their bills. Yeah. Because when they've done that in history, they're better off having defaulted than to print all that money, because their currency goes the way of the dodo bird and Zimbabwe. Wow. And so that's the problem is they're not... When Greenspan says we can just print all this money, no, you can't. You'll lose the currency, and that's a far greater risk.
Is it easier to bring back the Zimbabwe dollar or a mammoth?
Well, we have the technology.
We've got the DNA for the mammoth. So,
It's
Well,
not
you
going
know,
to be a mammoth. It's going to be a curlon.
And up till now, it's been, other countries can't.
Inside joke.
That took me a minute to get that.
Yeah.
Inside
All right.
joke.
That was a good one.
I think you meant to say other.
I got Corey's funny bone bad on there right there.
That's funny.
No, but that's why this is such a fascinating conversation. Is the risk free or is it not? Is it risk free ish?
Yeah.
And
I still wouldn't bet against the U.S.
think about the financial statement of Apple versus the financial statement of the U.S. Though Apple's is so much better, except the U.S. can print money, and that's why their supposed confidence is because of the printing.
Yeah.
So think about that. Your risk free is relying on your ability to manufacture stuff out of nothing, which brings us back to Noah. It's confidence.
It is a confidence thing.
It's confidence. So balance sheet. This is the other thing I think we might close with, and I've been talking a lot about this. We'll close with this thought from Jeff Bezos. Bezos or Bezos?
Yes.
Yes. Yep. Nailed it.
Well, how does he say his name? Hi, I'm Jeff.
I think it would be Bezos.
How does Jeff say it? We'll have to Google it and see how Jeff says it.
I think it's Bezos.
He, I don't follow him much, but I don't know where I heard this, but he said it, and I was like, yep. When he says it's really common for people to look out in the future and say, what are the big changes going to be? Let's predict the change of the futures. Yeah. He says you're better off if you say what will not change. What will be the things that don't ever change that you can build a business on, because it's not going to change. It's not a sandy foundation, it's likened to a rock. And so you build on this. This is what I believe. They talk about food, clothing, shelter is the necessity of life. Baloney. It's so much bigger than that now. Food, clothing, shelter, transportation. You got to have a railroad to get your food, clothing, and shelter now. Communication. Yeah. We're not living without cell phones because we're so spread out. We have to communicate because no one has a garden in their yard anymore. No one has Bessie the cow. My mom had Bessie the cow. My wife had Bessie the cow. They both went out and milked cows growing up. I don't have a cow in my backyard. You have chickens, you have ducks, I have fish. So we have some protein sources, but I don't have enough fish to feed my kids. And the fish I have wouldn't be good eating. You also have energy. In other words, we even Bitcoin needs electricity to even survive now, right? Yeah. It doesn't exist without that. Therefore, we have needs. So the way I see it is if and when all hell broke loose, the producers are in the posture of command. And this is why it's so important when you're competing against AI, is working for money is going to get harder and harder and harder and harder to do, because we don't need humans to do that type of work. And it's harder for you to become valuable, where ownership is so much more important now. So even if all hell breaks loose, people can't think about this wrong. Well, I don't want to own stocks, or I want assets, or the asset crash. No. You want to be in all times, all circumstances. Think about my Costco. Always think about my Costco. Go there on Saturday and see which direction the money flows. Yep. In a recession or in periods of growth, the money will always flow the same way. The volume of it may fluctuate, but the money will always flow towards producers, things that are manufacturing the things of life. You want to own stocks, and you really want to own stocks with AI. So this doesn't scare me out of owning stocks at all. No. Because at the end of the day, I'm still a producer of what people need. Food, clothing, shelter, energy, medicine is our priority for healthcare. Food, clothing, shelter. We spend more money on healthcare than any of that stuff anymore, right? So yeah, it's about owning things, and the best and simplest way to own production is to own shares of stock. Mic drop.
Agreed.
I don't know if that's a mic drop or not, but
it is. Absolutely.
That felt like a solid mic drop.
We're dropping the mic. We're dropping the mic. All right, you're still giggling.
Yeah. We're gonna talk about that. We're gonna talk about that one in a minute.
He didn't hear the last 5 minutes of anything I said.
I'm still laughing.
He's still laughing about that. Hey, you've been hopefully enjoying. We sure enjoy it. The three of us. Hope you've enjoyed this episode of the Cash Flow Academy podcast. And what a broad range of things to discuss. Education, always a key, and it helps you position yourself. So go to yourinvestingclass.com. Go there and download that thing and read it. It's free. I love free stuff. You know why? It takes away excuses.
Yeah.
It's there. Go click, boom. You go there right now. Yourinvestingclass.com. Click, download, boom. Read it. Oh my gosh, this will change my life. And you want to hang out with guys like this because they are way, way smart. With that, thank you, Noah. Thank you, Corey. And we'll see. Remember, like and subscribe. Hit notification bell. We'll see you next time.